Okay, we are back, and today I'm going to teach you guys how to determine draw on the liquidity. So let's start. So what is a draw on liquidity? Draw on liquidity is the market search for external and internal range liquidity. Okay, so we are using lower time frame concepts to target this sell side external liquidity or buy side external liquidity. So for example, first I'm going to show you the example on the daily chart right here. As you can see, overall trend is bearish. We are not watching, we are only watching on the examples right now. So we have this swing low and swing high right here. So let's mark our daily range right here, okay? So as you can see, when price comes back in a discount, price rallies, and we have this fair value gap right here. We have two fair value gaps, but you need to focus where will market reacts. Okay, so market reacts on this fair value gap right here, and market breaks this swing low right here. Why is this swing low? Because anytime market is moving higher, it makes, let's say for example, it makes down close candle right here. That down close candle right there becomes a swing low. Okay, so this is break in market structure right here. So we can target the next liquidity. Give me a sec. This low right here or this low right here. So this can be your drawn liquidity or this can be your drawn liquidity. So let's go on another example right now. Okay. So I forgot to say that you cannot only target the buy side or sell side liquidity. You can also target the higher time frame PDRAs like volume imbalance, fair value gap, order block, or any other price levels. Okay. So for example, right here we have this range. Right here, we sort of fib like this. Price comes back into discount, moves away. So where can be your drawn liquidity? As you can see, this swing high has been taken because this is a last down close candle before the up move right here. So this becomes a swing high right here, okay? And also the three candle formation, like short-term high right here, short-term high right here, and this becomes swing high right here, okay? So swing high has been broken. We have this order book right here. Focus how candle wicks respect this order block right here. So on the lower time frame, you can target this high as your drawn liquidity, or this high as your drawn liquidity, or this volume imbalance right here as your drawn liquidity. So let's go on another example. Okay. So as you can see, we have this reaction on the daily fair value gap right here, and price breaks this high right here. You can see the price comes back. We have this order block and fair value gap right here. Price respects it, and this high right here can be your drawn liquidity. So let's go on another example right now. Okay. As you can see, we had the sell stops right here. I'm not watching any all the structure because I'm giving you guys only examples. Okay. We had this sell stops right here. Price comes back to this fair value gap. You can see, and you can go on the lower time frame like 3 minutes, 2 minutes, 1 minute, and target this buy side liquidity right here. Excuse me, yeah, equal highs buy side liquidity. So let's go on another example. Okay, so as I said, we had the sell stops right here. We had shift right here, as you can see, and shifting market structure right here. Price comes back to this fair value gap right here, and this equal highs right here is our drawn liquidity. So we can take entry here, which are stop loss below the swing low. Why is this swing low? Because we have three candle formation right here. Short-term low, another short-term low, and this low becomes the intermediate term low. Okay, so we can target or drawn liquidity as this equal highs. So let's go on to another example now. Okay, so for example, we have price moving bullish right here. We had this bullish order block right here. Excuse me, this order block right here, and price reacted. This is a 1 hour chart. You can go on a lower time frame. You have shift right here, and this can be your drawn liquidity, or this order block can be your drawn liquidity, or this fair value gap can be your drawn liquidity on the lower time frame. So this was the drawn liquidity teaching video, and see you guys in the next teaching video.